Make smart, calculated risks, right? You don't want to just invest in every deal that shows up in your inbox. That's not a good strategy. But there are going to be good deals that you want to invest in, and you want to be able to identify those when they come.
Are you frustrated watching your hard-earned money ride the knee-jerking Wall Street roller coaster? Are you looking to diversify into alternate investments and set them on autopilot to achieve financial freedom? It's time to learn the ways of the wealthy. It's time to think outside the stocks with your host, Madhavi Jain, an immigrant from India and ex-IT professional who will bring you industry experts to illustrate a passive and holistic financial approach to build not just passive income, but also your generational wealth. Madhavi is on a mission to change the financial trajectory of one family at a time and 1,000 more to go. Are you going to be part of this vision? And now, without further ado, here is the host of Think Outside the Stocks, Madhavi Jain.
Hey, welcome to Think Outside the Stocks. I'm your host, Madhavi Jain, and we are going to continue our journey. We felt that we were left hanging with the knowledge that Ben was sharing in our last episode. We talked about inflation, we talked about recession, we talked about the asset class that you should be focusing on as a passive investor during these recessionary periods. But we did not get enough time to talk about these assets and why Ben is so bullish on these asset classes. So we invited Ben back to our studio so that we can dig a little bit deeper into these asset classes. Ben, welcome back to Think Outside the Stocks.
Yep, thanks for having me back. Looking forward to it.
Thank you. So for those who are just joining us, Ben comes from Aspen Funds, and they are managing $120 million equity for their investors. What's very interesting in this environment that Ben actually has experience from underwriting from banking side. So when it's managing risk and looking at deals, kind of a different perspective, he has this tremendous insight. So Ben, can you elaborate about how your underwriting experience is actually helping you to navigate and especially to look at and evaluate due diligence on the investments currently?
Yeah, absolutely. I had a several-year stint in commercial banking, and it was a great learning experience for me. And I never wanted to be a banker long-term. And it was, it's an interesting industry because people that get into that business generally don't leave. And you see, 30, 40-year bankers, because it gets pretty cushy after a while, and you can make good money, and you play golf every Friday, but I knew I wanted to be an entrepreneur, but I wanted to learn the basics of risk mitigation, right? And when you're a banker, you are in a unique position because you don't get to participate in the upside. If a deal performs well, you still get your interest rate and that's it, right? But you participate disproportionately in the downside, right? So if the deal does not perform well, you have to mitigate your risk. And the way that banks work, it's actually kind of ironic to me sometimes. People don't understand how banks work, but they're leveraged sometimes 8 to 10 to 1. So for every dollar of equity that they have in the bank, they have $8 to $10 of debt. And so they're actually very highly leveraged, which is kind of funny because you think about banks don't like to lend in high leverage situations generally. But because of that, they have a very minimal amount of ability to handle losses. And so they have to really manage their losses. So one of the great trainings and just experiences through that was learning how to look at the downside, how to think through what are the worst case scenarios and what's the likelihood of them happening. And if they do happen, what are the ways that we can protect ourselves and make sure that we're okay? And so, those are ways that I've, been formed in my thinking that help when we're making investment decisions on the types of opportunities that we invest in. But now I got to have a lot more fun because I got to participate in the upside, right? And but also be thinking and using that base of, how do we protect downside? How do we mitigate risk? And what are the risks, right? Because understanding risk is not a general thing. It's very specific to every deal and every investment. And to be able to quantify what those risks are, and then how do you specifically mitigate each risk? Or can you not mitigate a risk? And then are you comfortable taking that risk, right? So those are the things that are very, very helpful. And as we've kind of broadened our investing into multiple asset classes.
That's interesting. I mean, there are going to be always risk, right? I mean, I come from a project management background as well. Even I worked in consulting with Deloitte Consulting, and mostly in project management. To quantify that risk, to kind of mitigate that risk, create a plan for it, right? So you coming from that underwriting background, where you're working from banks, looking from a perspective that is this deal going to fail, and now you are looking at using the same kind of expertise to evaluate your deals. So that's great. So let me ask you a question. A lot of people ask that, is multifamily still a good asset class to buy in? Last episode we talked about recession, the inflation, and to be on the right side of inflation, you need to focus on real estate. So let's dig deeper into the real estate aspect. Is multifamily still a good buy?
Yeah, great question. And I'm sure one that a lot of people are thinking, right? Because
Yep.
it is, I would say, probably the most institutionalized asset class in real estate, meaning that it's got the most attention from the big players. It's got the most attention even from individual investors. And so it's the one that a lot of people pay attention to. And it's also performed very, very well for the past decade. So yeah, I think it's a loaded question, because do I believe that there's still going to be a high demand for multifamily properties? I think the answer absolutely, unequivocally, is yes. If you look at, we still have population growth, and really for the past 10 years, the early part of that 10 years, there's been a shortage of housing, right? And most of that
Right.
shortage has been on the single family side. So it was disproportionately under supplied on the single family. But what's happened is, as single family prices have gone, just exponential, and I think they're going to slow down in price increases, but it's still going to be going up, and it's pricing out a lot of buyers out of the market, and I think going to continue to be that way. It's going to push more people into multifamily. So now you're having population growth, you're having more people that can't buy, that are now being pushed into multifamily. I think those two factors are driving a lot of demand for it. And then we also saw, like you said in the last episode, very high rent growth over the past several years. And a lot of that was what I would say would be pent up demand, and kind of a catching up to where the market really is. And we're definitely think it's going to slow down. If not, rent growth in certain markets will likely go negative for a short period of time. But I do think the trend is going to continue because there is still a shortage of housing. So I think from that standpoint, yes, we need to be paying attention to multifamily. I think multifamily is still a good place to be. The challenges that we have right now in multifamily is, in the past several years, capitalization rates, or cap rates, have compressed so much, meaning that for every dollar of earnings that you're paying for, you're paying a lot more for it, right? So if your investors are more familiar with price to earnings ratio, it's a very similar type of ratio, a cap rate. And the lower the cap rate, the more expensive the property, and the lower cash flow it's going to produce. And so we've seen a cap rate compression, meaning cap rates going down, which means prices are going up. And so I still think multifamily is a great place to be, but it's difficult right now to find deals that are good opportunities from an investment standpoint, purely based on the valuations. And then you add in the borrowing costs and the interest rates going up. I'm actually a believer that I think interest rates are going to remain high for a period of time. I've been saying it all this year, actually, that interest rates are going to remain high through 2023 into 2024. And now the Fed's kind of showing their cards, and I think the market's reacting to, hey, this is going to be around for a little while. And the reason is because I think inflation is going to be here stubbornly longer than we would ideally like. So it's going to force the Fed to keep interest rates higher. But all that to say, I think there's definitely opportunities. We just recently are about to close on a property in 2 weeks, where we are buying a Class A new development property straight from a developer. There's a lot of opportunity to improve operations, there's way below market on the rents. And we're assuming a 3.49% Fannie Mae loan. So we can, take this really great interest rate, coupled in a great asset in a great market, And talking again earlier on the last episode about using debt to your advantage and using inflation to your advantage, those are
Absolutely.
a great recipe for success. So those deals are very hard to find. And so my allocation of multifamily, is slowing down because I want to get into really, really good deals. And I think they're definitely out there. I think we're actually going to see some pretty good buying opportunities going into kind of mid to late 2023, as a lot of the deals in the past several years were financed with bridge debt. And I've talked a lot about bridge debt on our podcast, Invest Like a Billionaire, and why I think that's a problem for a lot of these types of value add multifamily investments. And we'll get into that now,
Right.
but basically I think there's going to be opportunities. So very long answer to your simple question, but I think yes, it's a good place to be. I think it's something you want to be very selective in the deals that you invest in multifamily for the next 12 to 18 months. But I do think there's going to be opportunities. So I don't think it's hey, completely write it off and no more multifamily. But I do think it's a very disciplined approach to which deals you do.
That's, you said few great points there, Ben. Housing being the supply and demand, that disproportion has been going for such a long time. It's not a want, right? It's a need. People need shelter. People need a place to live. And we have seen the rent growth going up with inflation, inconsistent with inflation. So it's interesting environment that's been created in even multifamily. And what I like about multifamily, which is our core asset class essentially, what we call the fundamentals, right? The fundamentals of multifamily are really strong. It's a simple business plan. You come in, you provide value add, you increase rents, and you sell at a higher price than you have moved in, right? So it's a simple plan. It's been kind of repeated over and over and over again, right? So that's why I really like multifamily. You also insist on the cap rates. There is a cap rate expansion, kind of an adjustment going on. Actually, the lending environment, I think that is one of the biggest risks right now to consider. So when I am evaluating the deals, right, I'm looking at these two aspects, that how are the assumptions are, how conservative they are in terms of the cap rate expansion. They have to account for every year some kind of expansion, right? So that at the exit, if the cap rate is completely different, that actually they are ready for it, that there is a stress test done in them. Another aspect, which is really important aspect, is lending. Cannot insist enough on having the fixed rate. And there are people who moved last couple of years with variable rate and didn't purchase the rate cap, or did purchase the rate cap, and which has gone like exponentially higher in terms of prices. And that's kind of has dried up their cash flow, because now forget the property taxes, forget the cost to insurance. They have to pay for the rate cap, which is what they estimated and what they're paying is completely different now. These are the kind of deals we will start seeing, creating those opportunities. So great perspective on real estate. There are a ton of deals that come in, especially for passive investors, right? They start seeing these deals and they just don't know how to navigate these waters. So it's really important to see, to have that due diligence before they walk into that investment, right? So in terms of finding the deals, you mentioned the multifamily is becoming difficult even if you have money ready. But one aspect of it is that people are sitting on the sideline saying that, okay, if I don't see something, I just won't invest. Or, if I just don't want to be open about investing at all. But what's happening to their money is now that money is eroding to inflation. So can you talk to the fact that people who are sitting on the sideline and who are seeing this very, very rare deals coming in and still have that fear that it seems right, but I don't want to go in because I just want to sit on the sideline. Can you address to that fear?
Totally. No, I think it's a human nature, right? Everything around us is unstable seemingly, and there's, distress going on. It's hard to push against that fear. That's so natural to us as humans. But the flip side of that is most of the best investing opportunities occur when there's a dislocation of, the capital markets, i.e. investing into these assets, times of recession. So I think it's going to be a really good time to invest in select opportunities. It takes a little bit of guts sometimes, right? But if you have conviction in, the types of properties that you believe are going to do well, the operator that is managing those investments, and you have really good debt and a good capital stack in place, I think it's something that you shouldn't be afraid of, right? It's taking calculated risks are going to pay off in the long run on the deals that are going to be purchased over the next, I would say, 24 months. One of the quotes I love from Warren Buffett, he says, be fearful when others are greedy,
Yeah.
and greedy when others are fearful, right?
Right.
And that's how he's made all of his money at Berkshire, and it's just a contrarian approach, right? It's simple to say, it's much more difficult to do in practice, to fight the fear. But again, going back to what I said in the last episode, is you have to self-educate. You have to understand, you have to make smart, calculated risks, right? You don't want to just invest in every deal that shows up in your inbox. That's not a good strategy. But there are going to be good deals that you want to invest in, and you want to be able to identify those.
So in terms of multifamily, right, people have seen and gotten used to this high returns, this short exit. So since the trend is changing a little bit, that's going to start impacting, right? The numbers are not going to just pencil in just as high that as they have seen, or it's not going to be a quick exit. So we are in here for a little bit longer run when it comes to multifamily, right?
I think so. I think, we've seen the past few years a lot of deals exit early, a 2 or 3 year hold, because it was just a really good time to sell, and you're getting just absurd returns because of the cap rate compression. But I think we're going to see some rent growth slowing. We're going to see some turbulence in the debt markets continue to be. We're going to see there's been a huge surge of newbie syndicators and investors that haven't gone through recession and haven't weathered any storms, and they've gotten to bad deals, right? And so I think there's going to be some turbulence there. So I think there's definitely some things to pay attention to. But again, when there's, when others are fearful, there's a time to be greedy and to find those opportunities.
I absolutely love that quote. And it's true. It has, shown 2008. It has shown it's come true. So that's kind of leading to our next question. If not multifamily, or multifamily is getting more and more rare in terms of opportunities, what can they focus on? And you started talking about industrial last episode. Why are you so bullish on industrial? Can we talk a little bit about that?
Yeah, absolutely. And, if you want to dig into it, we have lots of data and resources on our podcast and our website if you want to dig into these trends. But I'll kind of give you just the real high level of what's going on and what we've kind of been seeing. So again, our approach to investing is looking at the macro trends, at the big picture, macroeconomic meaning big, and trying to identify areas in the economy that we think are going to continue in a positive direction for a long period of time. Because even when there's whims in the market, sentiment changes quickly, but you can identify these trends, and that's what we're trying to do. And one of the things that we've looked at, we like multifamily, but we like multifamily not because it's the only asset class we've ever invested or know how to do, right? A lot of times syndicators are, they have a hammer and everything looks like a nail, right? When it's, as an investor, you have to, every asset class goes in cycles, and there's a good time to be in every investment. There's a bad time to be in every investment. So it's important to know, not every asset class is going to perform equally in every environment. And that's obvious, but it's important to make the point, because we are looking outside of just multifamily, the big behemoth in real estate. We still like it, but we're more selective, and we found other asset classes that we are seeing some massive trends that we think we're really early into right now. And so one of those trends is in industrial. What we're seeing and what we saw in COVID, right? Everyone heard the excuse 1,000 times of supply chain issues, right? And all the slow this difficulty to get products in the door, to products completed for manufacturing, et cetera, et cetera. Well,
the chip shortage.
the chip shortage, exactly. Yeah, I'm glad you brought that up, because it's a great case study in what's happening. So, Ford auto manufacturers, They are sitting right now, I believe it's on somewhere with $3 to $5 billion of truck inventory that are
Wow.
just sitting in parking lots that cannot be sold. $3 to $5 billion. And
Goodness.
they can't sell them because they're missing a chip, a simple computer chip. And those are manufactured in other countries that are having massive, supply chain issues. And because they can't put those chips in, they basically have, a 30,000-pound paperweight. You can't
I
do
was
anything
just
with
going to
it,
say
right?
that.
Yeah, sorry, I took the punchline for you. But it's something that is so simple, but is so critical to the manufacturing process. And so what we're seeing is this, just Ford, this is a lot of big manufacturers.
Absolutely.
They want to de-risk portions of their supply chain, especially for critical components in the manufacturing process. So the rhetorical question is, how much is it worth to Ford to bring back the manufacturing of those chips to the U.S. on a chip that costs them a few dollars? Maybe it costs them 50% more, but in the grand scheme of things, of the entire manufacturing process of a truck, it's a very
Right.
insignificant cost and very, very significant to the bottom line if they can get those trucks sold. So that's the kind of calculus that is changing with a lot of manufacturers. And then you take in all the geopolitical risks, right? Now the Russian-Ukraine war, that's changing the calculus. Do we want to have overseas exposure to potential countries that are going to be at war? It's going to further disrupt supply chains. The other piece of this is energy costs, right? If you look, a lot of European manufacturers are actually looking at bringing manufacturing to the U.S. because there is a massive energy shortage. Europe does not have their own energy sources. They have to import all the energy, the majority of the energy. And that a lot of times for manufacturing is one of the single biggest expense items. And if that's increased by 4 to 5 or 10x in cost, it doesn't make sense, right? It makes sense to move the manufacturing to the place where there is abundance of energy, which is in the U.S. And we're actually the biggest energy exporter in the world right now. A lot of people don't realize
Right.
that. And then you add onto the fact, so you have these kind of more unique changes going on that have been exacerbated by supply chain issues through COVID. Well, this kind of slower trend that's now kind of caught up is the developing countries where a lot of manufacturing was outsourced to, especially China. Wages have increased 15x over the past 20 years.
Wow. Wow.
Yes. So if you include,
So it's not a cheap labor anymore.
no, it's not what it was. It's still cheaper, but if you add in wage costs, transportation costs, supply chain risks, actually starts to pencil pretty well to bring manufacturing back to the U.S. So there's been a huge boom in industrial for the past 10 years because of e-commerce. E-commerce has really driven a lot of industrial property need for distribution primarily. But we think there's going to be a second surge in industrial for a lot of manufacturing and also for distribution as well. But this is a trend we're already starting to see. There's a lot of manufacturing jobs being brought back to the U.S. I mean, the numbers do not lie, and it's changing the calculus where we used to be a completely globalized economy where let's just outsource everything. It's going to increase the bottom line because we can get it cheaper, manufacture somewhere else. Well, you're underpricing the risk of geopolitical risk, supply chain risk. All those other things that go into the kind of intangible costs, and let's if they bring those back and can control those pieces of especially critical components, it's de-risking the supply chain a lot.
Yeah, so it's almost like there was a period of globalization, and now there is a period of kind of deep globalization because we created so much of dependencies with other countries. We just got burnt really, really bad.
Yeah.
And, if I always tell my kids that it's okay to make mistakes, but it's not okay to repeat it. You got to learn from it, right? So as a country, I think we are learning from it and we're kind of bringing it back. which is important from the independence perspective, and also from all what you're saying, the cost perspective, and most essentially managing that risk, de-risking, as small as one small chip, one small unit, and just imagine how much massive losses just in terms of inventory or things happening to these vehicles. Just one company as big as Ford is going through. That's interesting. And Ben, you and me, we are very analytical people. We like to look at things, from a perspective of the risk, managing that risk. We like to look at from the perspective of the data that's backing it, what are the numbers saying, right? So in terms of strong data that supports it, can we talk about, what are these metrics? We talk about just the general moment, why, the industrial is kind of expanding. Are there any metrics that you are seeing which supports this process?
Yeah, I think the real simple metric, and I don't have the numbers right in front of me. We did a presentation where you have a lot of the data, but the big ones
Absolutely.
are the manufacturing jobs being brought back to America, because that is a contrary to the past 2-decade trend, right? Manufacturing
Right.
jobs have been being shipped out of America for so long, but the sentiment is really changing. So we're seeing new manufacturing plants being opened in the U.S. We're seeing a record number of manufacturing jobs being
Almost
opened
like
up in the U.S.
like
That
350,000. I think that's the number I saw last. The
yeah,
350,000. That's huge.
exactly, and it's a very, very big, I think, indicator of what's kind of an early stage trend. But you think about too, a lot of Ford just can't magically all of a sudden create a manufacturing plant in 3 months, right? It's going to take several
Yeah.
years, and so these are big, long-term decisions that require extensive capital investment, and so this is something that if you position yourself well over the next several years, we think over the next decade likely, this is going to continue to create an industrial boom, because right now the other data points are industrial vacancy in the U.S.
Yep.
is at
A very
all-time
simple data
lows.
point.
It's
Yeah.
yeah, it's under 3% nationwide, which is considered nearly 100% occupancy, because you have what's called functional obsolescence, where certain portions of properties are not leasable, right? So it just creates this
Right.
functionally obsolescent piece. So we're pretty close to 100% occupied, and we're also at the same time having this record low vacancy. We're delivering the most in the past decade of new properties per year, and it's being absorbed instantaneously because there's so much demand for it. So those are some of the real basic numbers and just the basic data that is supporting the thesis that I'm talking about.
That's excellent. I mean, in terms of the supply demand, and I think the vacancy rate and also the rent growth, that's kind of a simple metrics that puts industrial right very close to where fundamentals of multifamily is, right? I mean, multifamily is at what, like 95.6% occupancy. That's really high nationally. I think that's an indicative that it is worthy opponent of being right there, in terms of
Right.
fundamentals. With multifamily. What about when it comes to the manufacturing and you're talking about the whole AI and kind of the robotics impact to manufacturing? Can that impact, and is it a slow impact? Any thoughts on that?
Yeah, I mean, I think that's going to impact jobs. I don't think it's going to impact real estate investment, right? Because to have those manufacturing plants, you still need real estate. So that's
Yeah.
very good from a real estate investor standpoint. I do think, and I think this is a whole other separate topic, but I think there's going to be some massive disruption in jobs over the next 10 to 20 years. There's a lot of data to support this, but especially low-level, entry-level jobs that are repeatable, that can be replaced through technology, that are what I would call non-knowledge worker jobs, so that don't
Right.
require more physical labor versus require intellectual labor. Those jobs are going to be more easily replaced, and to the extent that robotics, AI, and technology continue to become more efficient, more cost-effective, and can replace those jobs, that is going to have a negative impact on jobs. But I think from a real estate standpoint,
Not for the real
it's
estate.
going to be a nominal impact.
And that's great. So to wrap that industrial segment, We also mentioned a little bit about, oil and gas, and we don't have too much time today. But can you just kind of touch that point about the energy and oil and gas, and what people should be careful about it?
Yeah, absolutely. The real quick points to make and why we're really bullish on oil and gas right now are a few things. One, the ESG narrative. So ESG, environmental, societal, governance kind of programs have been pushing toward the kind of renewable energies for many years, and nothing to speak to the ethics or morality of ESG. What it's done is caused massive decrease in capital investment in traditional hydrocarbon exploration. So hydrocarbon being oil and gas. A lot of these companies that have been drilling for more oil and more gas in the U.S. At least has decreased by 50% over the past roughly 5 to 7 years. And if you think about the nature of oil and gas, it's a depleting resource, right? There's a limited supply in the ground, and it's being pulled and pumped up every day. So if you're not drilling, you are increasingly, or you're inevitably going to decrease the future supply. And so part of this is the ESG narrative has kind of put these oil and gas producers in a negative light, right? Where they're taking capital away from them. There's certain politicians that are going around to large banks defunding investment into these producers. And so what that's doing is it's causing a kind of supply challenge. And then you also add in now the Russia-Ukraine war. So Russia is one of the biggest exporters of oil and gas. Those products are right now trading at a pretty significant discount because no one wants to support Russian oil to continue to wage their war. So Europe is in dire straits because that's their primary source for that oil and the gas. And so it's kind of changing. These kind of geopolitical factors are really impacting pricing of oil. You look at the supply is not going to be there in the future. It's not there right now, and over the next several years, it's going to continue to decrease at a macro level. And then you look at what's going to replace it is renewables. Well, the challenge is the current mandates for kind of getting to certain metrics and benchmarks for renewable energy. They are completely unrealistic. One real simple number that I like to pull out is, of all the cars that were sold last year, I believe it was roughly 5% of them were electric vehicles. Right? So a very small percentage, but of that 5%, it used 60% of the global lithium production that year. 60%.
Wow.
So if we want to get to, 50% vehicles being sold are electric vehicles, and I forget the actual benchmarks over time, but they're pretty fast numbers, and they're completely unrealistic.
Yeah.
They're completely disconnected from reality and of all the actual mining and other materials that we need to get and increase, not just incrementally but exponentially to meet these standards. And then it's kind of ironic too that the mining of lithium and these other materials is actually extremely dirty business. It's very, very not environmentally friendly, and a lot of times in not great working conditions, et cetera, et cetera. So it's kind of, this whole narrative has caused this very disjointed approach, unrealistic expectations, and what's going to happen is supply is going to continue to go down. Demand has continued to remain steady for oil and gas, if not increase. And now you add in the kind of other global players that are needing fuel sources from other places than Russia. You're talking about a recipe for high oil prices. Goldman Sachs, and JP Morgan, they're projecting oil prices to hit in the mid $100 per barrel, if not $200 per barrel. Right now are about $80 a barrel, and those prices are a little hard to wrap your head around. And maybe they don't happen. In our modeling on deals we're still doing $80 a barrel, but it's something that we think is very possible over the next several years.
So much of compression is getting created, is kind of putting that pressure and just pushing that, the whole demand just up. That's interesting perspective, Ben. I think we need another segment to dig deeper into what you have been just saying. But unfortunately, we will have to stop here today. But we will have a quick segment about our think outside the stocks before we, jump out. So my question is, my time is going to be a little bit different. Instead of investing outside the stock, I would like to know how do you measure your growth? Because most commonly our passive investors, they're just like everywhere, right? If they're outside the stocks, if they're like just everywhere, what is the best way for them to measure their growth? So do you have some kind of like a dashboard created for yourself? How do you measure your own growth?
And we're saying growth, do you mean like financial growth primarily, or everything?
Yeah, just your portfolio. How do you measure that? How is it doing over the period of years, and how do you just plan for that?
Yeah, I think one thing that's a helpful perspective is what I call shifting from an income statement mindset to a balance sheet mindset, right? So much we're so focused on what's my income going to be this year, but it's really shifting to what is my net worth? What is my actual balance sheet? What assets do I own? And as those assets continue to increase, what's the potential to convert those into cash flowing, assets? And so I'm at a stage of life where I don't really need the cash flow. So
Right.
I'm disproportionately allocating my investments to higher growth, higher return investments, because the faster I can grow that, then eventually I can convert those to more cash flowing opportunities. But I think, looking at your balance sheet, measuring if you do have allocations in the stock market, sometimes it can be difficult to measure what your actual return is, net of fees, net of contributions. It's actually a pretty difficult number to calculate. But I think obviously you want that net worth number to keep going up over time, right? And so,
Right.
that's going to be a combination of investing into new assets every year, reinvesting gains from current assets into other assets, and continuing to kind of get that compounding, flywheel working for you. When you're in private equity deals like real estate and other types of deals, it's important to measure, understand what your liquidity needs are, right? Because one of the biggest downsides of real estate is lack of liquidity, and so you
Right.
need to measure that well and accurately. But I will say, as a positive, there's been a lot of research done that most people overestimate their need for liquidity.
Right.
So be conservative on that, but at the same time also realize that you may not need as much as you think you need.
Great advice. Thank you so much. I think outside the stocks actually focus on three things. One is to increase your, cash flow, decrease your tax liability, because those are kind of the leakages too, and increase your net worth, because we have to kind of provide that perspective. One question that I'm going to ask you, coming from the banking side, and I'm also a big proponent of the infinity banking system, essentially creating your own bank, family bank within the life insurance, whole life insurance policy. Have you done that, and how do you use it?
I have done that. I did it about 5 years ago, and
Great.
it takes about that long to get the policies to become efficient from a contribution standpoint to what you're earning in dividends. So yeah, I definitely use it. My perspective on it has shifted over time. When I first kind of got the policy, my perspective was that it's going to be a replacement as an investment. But
Right.
that's not, I think, a good way to view it. I view it as a way to make your capital more efficient while your kind of velocity of money is a phrase a lot of those people use in that. And what that means is, you have your cash value that you're building over time, and that is going to be earning consistent dividends. You can keep growing, and then you can use that cash value. You can take loans against it to invest in other opportunities. So for me, I view it as primarily my liquidity kind of fund, right? So I like to keep a lot of liquidity there. I use that as kind of backup liquidity, so kind of more bridge funding into investments, and then I'll pay it back. But it is difficult to kind of purely match the, because the idea is you can take a loan from yourself and you pay yourself that policy. The problem is I'm not that disciplined to do that over 10 years. I'm like, oh, I don't really need it this month or whatever. So if you can do that, more power to you. But for me, I use it as primarily a liquidity fund that I can use to fund deals and then pay it back, and not have to be reliant on a bank, and have access to funds when I need them, and also for short-term opportunities that I can take advantage of.
Yeah, that's a great point that you bring in. In fact, I always distinguish that one is a saving strategy and one is an investing strategy.
Yeah.
The banking is the saving strategy when you are making as efficient use as you are doing it, right? Just parking there between investments, kind of that dry powder when there are opportunities, which is going to be in sometime soon future, right? So that's great.
Right.
With that, we're gonna go to our last round about the rapid fire. Just a couple of more minutes. What is the one advice that you would give to the investors, the passive investors?
Yeah, I mean, it's going to be similar to what I said before, self-education, but I would also say that you can figure it out. You can do this. You can be in control of your money. You're smart enough to figure it out. Surround yourself with people that are going to help you, empower you to do it. Because one of the things I find in a lot of conversations with investors is they feel like it's too confusing, it's too difficult. My financial advisor says I have to do this, so that's what I'm going to do. Well, why? Have you challenged the assumptions? What are the assumptions? Why is that the best approach? Not to say that they're wrong, they may be right, but the importance is taking control, taking ownership of your own money, right? You've worked your entire life. You've worked very, very hard to accumulate the money you've had. People do not work as hard to manage and grow and build on those funds that they've worked so hard to get. And I think you need to take an equal, if not greater, sense of ownership and of growing your net worth and growing your investing as you do to create the investable cash. So I would say that is, one, you can do it, and two, you need to do it.
Great advice to kind of bring in that confidence. That's really essential to take that action now. I think that's most important. One last question. What is that one advice that you received that, kind of changed your path, changed your journey in your financial structure?
Yeah, I think it's probably a lot of things. I think it's one, having people that believe in me, right, and believe that I could do things that I wanted to do. But I think, kind of going along with the theme of your show, thinking outside of the stocks, think outside the box. I think it's important to challenge convention, because especially in investing, it's so much centered around herd mentality, right? Well, I'm just going to invest this because everyone else is doing this. Oh, well,
Right.
Crypto must be the next big thing. FTX is the next big thing, right? Well, we found out that it wasn't, because,
I know.
and he had a lot of very smart investors that he, got hook, line, and sinker sold into it. But it's just the nature of humans. We like to be where everyone else is because we assume that that's the best thing, right? And so I think it's important you got to swim a different direction sometimes. You got to challenge the convention. Sometimes the convention is right. I found most of the time it's not, right? And that's how you become a disproportionate success in your investing, is looking in places where other people aren't. It's part of the reason why we're looking at these other asset classes, is we're finding areas that we think are going to produce, outsized returns based on the trends going on that other people may not be looking at.
Mind blown, absolutely, Ben. You had been such a great guest, and I'm sure that our audience has so much to take away. So thank you so much again. And those who are listening, thank you so much for listening. There is tremendous knowledge bombs that Ben actually had in these 2 episodes. I am just hoping that you have some kind of direction, some kind of, thinking to do as a tidbit from this episode. So thank you so much, Ben, again for joining us and this tremendous knowledge. I really appreciate it.
All right. Thanks so much, and really appreciate you having me on, and it was really fun.
Thank you again for tuning in, and hope you got a little bit perspective into the industrial and multifamily as an investment class, and why you should not be just thinking about keeping your money on the sidelines and not participate in the tremendous opportunities that this investment classes bring you. So hope you have a lot of takeaway from this, and I hope you join me in soon in the next episode. Thank you so much.
Thanks for tuning in to the Think Outside the Stocks podcast. If you enjoyed today's episode, please like and subscribe. Madhavi is on a mission to change the financial trajectory of one family at a time, with 1,000 more to go. We hope you'll be a part of this vision. Please join our growing community, and to get your journey started, visit thinkoutsidethestocks.com to download your free guide on active income with passive real estate investments. If you learned something new, please share it with one person today. And if you have 60 seconds,